Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's senior derivatives and portfolio manager at PI Financial in Vancouver. His website, PolarFuturesGroup.com. Welcome back to the show, Victor.
Jim, good to be back. Thank you.
Victor, the benchmark American and Canadian stock indexes were at all-time highs in late November after a huge rally from last December's lows. What do you think accounts for this rally, and do you think it will continue?
Well, that is really the $64,000 question, isn't it, or $64 million or whatever. But, well, let's start with this. I mean, a year ago now, the market was doing a serious plunge. We got into a real hole, I guess, just around Christmas time. What had happened at that time is Fed Chairman Powell raised interest rates, and people were going, wow, and that just seemed to be a real surprise, and the market went down hard. And then we had what we called the Powell pivot. And I'll focus on Powell for just a sec, because when he came along as head of the Fed, me and I think a lot of other people as well thought, hey, this guy is going to be different. This guy is no Greenspan. He's no Bernanke. He's no Janet Yellen. This guy is going to try to get things sort of back to normal, which in a way meant, let's get interest rates up from off the floor to something a little more historically normal. That seemed to be his tone, and I think he talked that way up until the pivot, even though he was getting flack from the president and all that sort of thing. But he had a change of heart, I guess around Christmas time or thereafter, and the stock market started to rally. So in terms of why has it rallied, I mean, the S&P, the main benchmark, is up about 25% year to date. It was actually had rallied a little bit the last week or so of December as well. It hasn't been just a straight forward rally. We did have a little tremor in May when the market backed up about 7%. Then we had another little tremor in August when it backed up about 5%. But really, the market has had a pretty good march to higher levels. In gross terms, there's just been more money and less stocks. I mean, the Fed has been making more money available. They've been consistently cutting rates this year. And you remember in December of last year, they were forecasting that they would be raising rates this year. So the Fed having an easier monetary policy, especially lately, has helped stocks go up. But as David Rosenberg likes to point out, now he's bearish, okay? So you got to understand that. But he is saying that price earnings, price to sales, price to book ratios are at least one standard deviation above historical norms. And what that means to me, well, let's say he would argue then that the rally has been driven by multiple expansion. In plain language, what that means is people have been willing to pay more and more and more for a dollar of earnings as the stock market has risen. Now, people, that's like the investors. On the other side, corporations have been buying back stocks like there's no tomorrow. I think over the past, I'm going to say 8 years, maybe it's 9 years, something like that, there has been something in the range of $5 trillion worth of stock bought out of the market by corporate buybacks. So that, together with these ultra-low interest rates, creates an environment, I think, where the thought is there is no alternative. You've got to be in the stock market. Certainly, if you think in terms of people out there in the world that are participating in the stock market, there are way more people who are running other people's money, or at least the money that they're running is way bigger, way more important than, ma and pa out there trading, online in their pajamas. And those guys are driven by what we call career risk. If you don't keep up with your peer group in terms of performance, people are going to take money away from you and give it to somebody else. So, I remember early October saying to my son, Drew, if this market goes up and makes new all-time highs again, people are going to have to buy just to keep up with the Joneses, as it were. So we've had any number of things. The market has been in a good, strong rally, although, and you might have known that was coming, we did hit highs right at the end of November. We had a quick little hard break early last week. I was on the short side of that. I'm inclined to think this market is pretty much priced for perfection, and I am willing to take some limited risk pokes at it to see if it won't fall. By price for perfection, the market kind of yo-yos around on little bits of news that come out about the China-U.S. trade talks. It seems the market really wants to believe that some deal's going to get done, and that'll, open the floodgates to prices going higher. I think the market is definitely pricing in Trump being reelected come next November. Now, it may be too early for people to really start voting with their feet there. But if we go into the new year and there's some doubt about that, particularly when you look at some of the people on the Democratic side and the platforms that they have, people that have got a lot of money in the stock market might have second thoughts. We've had really, really low volatility in the market. It's like it's complacent. So there's some reasons, I guess, why it's gone up. I'm from Missouri. I'm inclined to short it here, but at the same time, I'm not taking this isn't the position I'm going to get short and come hell or high water, stay short. From a trading point of view, I poke at it, and last week I got a good move to the downside. If the market goes against me, I'll close my position and just watch the rally keep going, I guess.
We'll have more with Victor Adair right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Victor Adair. Victor, in interviews over the past couple of years, you've been quite bullish on the U.S. dollar. Do you expect it to continue going up?
Oh, well, Jim, there's another $64,000 question. And I gotta say, I feel like I'm changing my mind a little bit. I have been sort of resolutely, from a thesis point of view, bullish the U.S. dollar. And my sort of one-liner for that is that capital comes to America for safety and opportunity. And I think that has definitely been happening. Like America's been a magnet. And people will particularly say folks that are inclined to be really bullish on gold will, denigrate the U.S. dollar, point out all the problems that are in the U.S. dollar. And I say, fine, I don't disagree. But when we're trading currencies, it's just one currency relative to another. And would you rather have, the U.S. dollar or the Venezuelan bolivar? Well, no, that's an easy answer. But capital has come to America. But I'll tell you this, we made an important high at the end of 2016. The market trended down for a while through 17 and in very early 18. And since then, markets rallied back up again. But we've got nowhere near, this is on the U.S. dollar index, the highs that we made at the end of 16. And I'm wondering if the U.S. dollar isn't running out of steam a little bit. Now, it's not monolithic, obviously. When you're trading the U.S. dollar, you're trading the dollar against one currency or another. So some currencies may be doing better and some currencies not doing so well. Probably as we go through this interview, let me do it right now. I'm going to talk about a key turn date that happened at the beginning of September. And I think the epicenter of that key turn date was when interest rates in the major markets around the world, that is the United States, Europe, and Japan, stopped going down and started to rise a little bit. And, we were at, call it virtually all-time low interest rates on bond yields at that point in time. That was the point in time also when we had the biggest possible imaginable stack of negative yielding debt in the world. It was north of $17 trillion at that point. And it wasn't just the bond market that turned at that date, and that's why I call it a key turn date. There's so many markets turned, whether you're looking at gold, copper, wheat, a number of other markets. And I think we might be in a regime change to some degree here, and that will ripple through the currency markets as well. So I started this by saying, I've been strongly U.S. dollar bullish. I've been rewarded for that with some of the trading that I've done. I really haven't had much of a position in the currency markets, I'd say the past month or so, and one of the reasons for that is they've been dull as dishwater. I mean, the volatility levels are low. The implied volatility on the euro currency is the lowest it's been since the thing was, brought into being 20 odd years ago. So maybe just that lull before the storm or something. Anyway, answer your question. Yes, I've been bullish U.S. dollar, and I think I'm changing my mind, but I haven't voted with my wallet yet.
Uh-huh. Now, of course, if we're talking U.S. dollar, we compare it to the Canadian dollar that's been drifting sideways in a 2-cent range now for the past few months. Do you think the Canadian dollar could go higher now that the U.S., Mexico, Canada free trade deal has been done?
The USMCA, I think is the new term instead of NAFTA. And, that's probably given Canada a little bit of a lift. I mean, as we're talking today, it's up 1/3 of a cent, and the Mexican peso is up about the same amount. But at the same time, the U.S. dollar is kind of weaker across the board. Let me go back to this on Canada, and this is really key to understanding Canada. I mean, we think of Canada versus the U.S. dollar, of course, and that's the most important exchange rate. It's so important that Canada versus other currencies doesn't mean much to any of us. But in the last year or so, Canada's actually done pretty well against a lot of other currencies. And even though it's been dull lately, like a lot of the other ones as well, it has not broken down below this 75-cent level. I've been making some bets on Canada, thinking if it broke down through that level, it would tumble some more. And those bets haven't been working out, so I've just, I've stopped doing that. I saw a major Canadian bank research piece a week or so ago, and this is their looking ahead a year forecast, and basically it was sell Canada against everything. And I thought, wow, that's a very bearish report. And I guess probably the essence of that was they were focused on, let's say, the indebtedness of Canadian consumers. We've certainly seen Canadian bank shares slide lower here over the past couple of weeks, so maybe that thinking is in the market. But when you're looking at Canada versus the U.S., or you say, what are the drivers, the Canadian dollar value? How the U.S. dollar is doing against most currencies in the world is really important. So if the U.S. dollar is weakening, or maybe weakening, as I was just saying in our last question, that would be good for Canada. The interest rate spread is always important, and it's kind of gone in Canada's favor. I mean, we've seen the Fed cut rates 3 times this year while Canada stood pat. And then the third component to the broad picture of Canadian dollars is commodities. And commodities have actually been trading higher here since that key turn date. Whether you're looking at Copper prices had a low on that date. A number of other commodities. I mean, even if you listed off, cocoa, coffee, sugar, cotton, all of these things been trending higher. The grain markets, not so much, but commodities generally, and certainly especially crude, have been trending higher. So that's been giving Canada a lift. I guess I've been sort of bearish on Canada for so long, and I mean years, and that's I've done well with that. It's maybe hard to do a pivot and start to be a buyer of Canada, but I've stopped selling it.
Now, of course, the Canadian dollar being almost pegged to the price of crude, what do you see happening with crude at $59 a barrel after OPEC and their buddies agreed to cut production a little bit? What do you see ahead for crude, and how would that tie into the Canadian dollar, although Ottawa probably doesn't see the connect?
Well, there's definitely a correlation between how the Canadian dollar goes and how crude goes. There's also a correlation between how the stock market is doing and how crude does. I've noticed over the past couple of years at some key turning dates that the stock market and the crude oil market sort of make a turn in the same direction around about the same time. So since, let's say, the beginning of October, for instance, which was the last low we had in the stock market, crude has traded higher from about $51 to, like I say, $59, as the stock market has traded to new all-time highs here. The supply-demand analysis in crude was so heavily weighted to paying attention to the supply side. In other words, people were watching whether or not OPEC was going to do production cuts. They were watching the rapid growth of American production, that sort of thing. I think on that side, the thing that sort of sticks out is that the rate of increase in American production is expected to really fall. In other words, American production has just ramped up a lot in the last couple of years. I mean, huge, and it's been significant. But that rate of increase looks like it's going to taper off. So, that's, say, bullish. Short-term bullish here, we've had negative inventory reports on crude this week, and the prices stayed pretty good. I mean, we've dipped a bit, but, we're still trading here near $59 a barrel. So, that looks good. Partway through the summer, I guess, August thereabouts, there was a lot of thinking in the markets that we were headed into a recession. That was the time when interest rates were getting very low, yield curves were inverted, and that was also a low period of time for the crude oil market. I'm talking the demand side now. I mean, classically, you could expect that if economies are strong, demand for crude is going to be strong, and vice versa. So the thinking in the market now seems to be, it looked for a while there like maybe we're going to have a slowdown, but maybe now it's just like a midterm correction. So I think that's putting a bit of a bid into the crude oil market as well. Now, I've said that on the stock side, I'm inclined to think the market is richly priced here, probably priced for perfection or whatever, and as a short-term trader, I'm willing to poke at it from the short side to see if I won't catch a break. And I might think something the same on crude, although at the moment I don't have a position in crude. So obviously, if I had a strong opinion, I'd have a position on.
We'll have more with Victor Adair right after the break.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, in our recent interviews, you told us that gold would weaken a bit after the big $350 rally it had. It's fallen about $100 from its height. Where do you see it going from here?
Let's start this way. The gold price a little over a year ago, from that level, it rallied about $350 to the key turn date at the beginning of September. I have had the view that that rally was very much tied to falling interest rates during that same period of time, especially falling real interest rates. And real interest rates is what you get after you look at the bond coupon, strip out the inflation rate, and this is what you get. During virtually all of that time, real interest rates were negative. And a negative interest rate environment is good for gold, as let's say a high interest rate environment is not good for gold because you're giving up interest or you got to pay interest to own gold. So the key driver to me during that $350 rally was falling interest rates. Now usually you think in terms of dollar, US dollar has been the flip side of gold. So if gold is strong, the US dollar is weak, vice versa. But during that period of time, it's like the interest rate market overshadowed any changes really in the currency market. But I'm wondering if that's not changing a bit right now, and I'll get to that in a minute. The vulnerability was this. When the gold market ran up the way it did, particularly the COMEX market where people can trade gold with a lot of leverage. As the market rallied and people believe more and more in the story that the prices are going higher, they bought more and more. So what we saw getting into a couple of months ago was that the net speculative long position on gold was bigger than it had ever been before. So in a way, as your mom might have said, you're cruising for a bruising. When the market is that heavily weighted one way or another, if something goes wrong and the prices start to drop, some of those people could become sellers and sort of exacerbate a decline. That was the vulnerability in gold. Now, gold price has backed up $100. I've been expecting it's probably got more to go, but it's not. It seems like it's kind of holding in here, and those speculators they've pared their positions back a bit, but not a lot. So far the speculators have held in, and now I'm wondering if we won't have, call it like a passing of the baton from the interest rate market to the U.S. dollar or the currency market. If, in fact, the U.S. dollar starts to weaken in this environment, I think then gold goes back on the bid and prices could be rising from here. So I'm watching that very closely. I think there certainly is still some vulnerability there because we had this very large spec long position, and if prices did for some reason fall, those guys might start to throw in the towel. But I've liked the way gold has held, and I'd be looking maybe to take a position on the long side, particularly if I get more convinced that the U.S. dollar is weakening.
Are you trading or watching for opportunities to trade in any other markets?
I think I've kind of mentioned the bond market. Probably the best trading results that I've had over the past couple of months have been shorting bonds, on the view that, that September 3rd key turn date was the low for interest rates, the high for bond prices, and I've been intermittently shorting bonds. Here's a trade I had, a brainwave. I was noticing how a lot of currencies across South America were getting clobbered. I mean, I was certainly aware Venezuela had, been just gone to dust. Argentina, their currency was falling up a lot. But the one that really kind of caught my eye was Chile. It had stayed relatively strong. But then with these riots in the streets and so on, the currency took about a 10% hit in just over a month. So I was there, and there's other currencies, whether it's Bolivia or Colombia, weaknesses down there, and I wondered if we wouldn't get some contagion in Mexico. And I thought, I could see that Mexico could be ripe to have some of this social unrest in the streets, like we've seen in places in South America and other spots around the world. And if that happened, that might wash over into the currency. And you go back and look at charts over the past 20, 25 years, whatever. I mean, the Mexican currency, on balance, just keeps getting weaker and weaker and weaker against the U.S. dollar. So I put on a trade where I was short Mexican peso, just kind of waiting to see if it would catch this contagion from South America. It did fall some, but wasn't really making the case. And then as it started to turn to go higher, I thought, this is not a timing tool, this idea I have. This is just like an idea, interesting idea. But I thought, okay, and this goes to one of my real trading principles, and that is, I don't care how good I think my idea is. My risk management, my desire to protect my trading capital and my sanity overrides any brainwave I've got. And I thought, this isn't going the right way, so I think I'll just get out. And it's a week or so since I've done that. I'm happy to be out because the peso's had a pretty good rally. So I'm looking around all over, whether it's stocks or interest rates or currencies or metals or whatever. And the thing that is really kind of intriguing me here is the what if. What if the U.S. dollar is weakening? That's a tough one to get my mind around because, it's been strengthening for several years and I've done well trading that way. But as a trader, you got to be willing to change your mind. That's for sure.
Victor, thank you so much for chatting with us.
Hey, Jim, it's always a pleasure to talk with you. Thank you, and look forward to talking to you again.
And have a great holiday season.
Oh, yes, you too, of course. Thank you.
My guest has been Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. You can find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.